Today I will be presenting a brief research report on Zomato. By the end of this video, you will get to know 5 insights which you did not know earlier on Zomato. Insight number 1, market share. Coming to the market share, Zomato has 45% market share in the food delivery space. Insight number 2, revenue mix. Coming to the revenue mix, 81.4% of the sales come from delivery revenue, 12.8% from Hyperpure, and 5.7% from others. Insight number 3, location-wise breakup. Coming to location-wise breakup, 95.8% of the business comes from India, 3.2% from UAE, and 0.9% from others. Hence, most of the company sales is concentrated in India. Insight number 4, ROE and free cash flow. As the company is making losses, it has a negative ROE. Also, the free cash flow has been negative for the last 5 years. This is not a healthy sign as the accumulated losses continue to mount year after year. Insight number 5, market return. With a 1-year negative return of minus 58.53%, the company has significantly underperformed the Sensex, which gave a positive return of 4.85% during the same period. Valuations. With a price to sales ratio of 10.13 times and a P ratio of 0, the company is overvalued. As the company is making losses, the P ratio cannot be calculated. An interesting point to note is that the company has not made any profits since 2018, and the accumulated losses keep getting bigger year after year. If I were a long-term investor, I would definitely stay away from this stock. I would wait for the company to report good quarter results, and if the company makes good profits, then I would consider entering the stock. For getting more such research insights and in-depth stock analysis, please join our Stocks Made Easy group. Thanking you from team testmystock.com.